Well, I think firstly, just to stay apolitical, it's really more about the job side of things and also the price stability side of things. It's still very much about the central bank and the Federal Reserve. So while jobs are adding, that's fantastic, but what we kind of see is that it's also skewing perception away from the price stability side of the equation. And that's obviously where monetary policy is really going to be watched still, when you still have a global deflationary environment and you have basically a lethargic inflation environment.
Let's switch gears, Gavin, to China. Where are we in this cycle in the China markets? A lot of people are saying that we are in the capitulation phase, which is typically the most violent part of this process. Would you agree?
Well, they're still going through a very, very big transition stage at the moment, and one of the hangovers of that is the inventory build-up and the overcapacity in the old economy, let's say the investment-driven part of the economy, which is very much the industrial and manufacturing side of things. So actually today's trade data, which was a stark beat in a lot of senses, and in renminbi terms, if you scratch the surface on the headlines, the exports to Europe were positive, whereas prior it was negative, and to the US was a deceleration of a contraction of exports to the US. So those things are quite positive because they're also going to help flush out the inventory build-up and obviously help on the overcapacity side. And that's very, very important because, again, China's facing its own deflationary situation with a decelerating inflation rate and a continued contraction on wholesale or factory gate and PPI pricing.
Broadly, I want to take a step back, Gavin, because there are a number of people who are saying that the current market conditions are a prelude to the type of sell-off and the type of destruction that we saw in 2008. Let me bounce this off you. Note to clients from the credit team at RBS yesterday. This all looks similar to 2008. We stick to our 10 to 20% equity downside call. In a crowded hall, exit doors are small, risks are high. That's pretty ominous stuff, in my opinion. Is this fear-mongering, or is RBS onto something here?
Well, I mean, obviously we've had the worst start to a financial year or market year that I've seen in the 20-odd years and 16 years in Hong Kong. Obviously China's a very different situation because it's still very much a closed market, particularly in relation to access. The fact it's heavily retail investor driven for the mainland and obviously the currency controls. Look, there's still a lot of uncertainty out there. I think really for us right now, the key is going to be the monetary data that comes out at any stage, which is the new renminbi loan growth and also the M2 money supply. And then next Tuesday we get the GDP. And obviously the official channels are saying, you had Premier League come out today and say it's not going to be under 6.5, and yesterday the NDRC said we are going to hit 7. But if you do take a step back out of China and look in the region, which is a lot more institutional invested, places like Japan, we've just come out of the first update trading for the year. I mean, we've had 5 sessions of downticks on the Nikkei, and we actually had a brand new record, which was 5 sessions consecutively of over 40% short selling turnover. So as we're getting to these key levels, as you mentioned earlier, I mean, down in Australia, it's 5,000, here in Hong Kong, 20,000 on the Hang Seng, and then up in Tokyo, we're looking at the 18,000. Things like these kind of heavy short selling turnover days are obviously going to create volatility, particularly as people cover these things.